Welcome back to the Passive Investor Meetup, Syndication Simplified. My name is Ryan Gibson, and I'm with Spartan Investment Group, and I'm joined tonight by Tyler and Igor, who have also helped put on this event. We have this every other week, usually around 4:30 Pacific time, and tonight we're talking about investing with self-directed retirement accounts or self-directed IRAs specifically. So if you wouldn't mind going to the next slide, we're going to talk, the purpose of the group, if you're joining us for the first time, it's just to talk about syndications, just to talk about passive investing and increase your level of sophistication as a passive investor. The networking and community part of this, hopefully, when COVID dies down, we'll go have this at the Spartan office in Bellevue. At some point in the future or another location, but it's to introduce other passive investors and sort of get quality opportunities, good education, things like that, and also do project site visits on syndications that are live and in our immediate area that we can drive to. So the mission, we put a little mission up there to enhance passive investor knowledge in the greater Puget Sound area. So just basically, we wanted to kind of keep this local. We're not trying to make this a huge nationwide, 400-person event. We're just trying to keep this local to, real investors investing in passive deals and syndications. So I think we have one more slide. One more, starter slide. What is a syndication? Obviously people here have done syndications, but it allows you to invest in development. You partner with more experienced team. You can do single-family, multifamily, Broadway shows, self-storage, new construction, fix and flip, whatever it might be. You can invest by pooling your funds together and then doing a deal with an operator. So you have the passive investor, you have the operator, and sometimes you even have like a syndicate that just raises capital for deals, or multiple different ways you can sort of come into contact with an operator. So, but with that, don't want to blab too much. Got a disclaimer here. We'll get that out of the way. Obviously, we're not attorneys, accountants, CPAs. Do your own due diligence. Get your own professional and legal team, and certainly do your own due diligence. This is just a friendly conversation, and consult with the professionals that be, and we are not providing that advice to you. That's what all those words say. So, so tonight I want to turn things over to Ted Green. So I'm gonna get really excited here for a minute. Ted Green is over 20 years in financial services. As an RIA, he's got, had his Series 7, Series 63, and 65 at one point. Over 20 years at Merrill Lynch, is a very knowledgeable person about self-directed retirement accounts. In fact, he helped WealthFlex basically start their self-directed retirement account company, which was later acquired by Yield Street. And if you're familiar with Yield Street's kind of a syndication investing platform that helps identify operators like Spartan and others, and they do kind of funds to raise for syndications. Well, Ted's company was bought by Yield Street, went over to work at Yield Street for a little bit, but reached out to me and really wanted to join the Spartan team. And I was overjoyed because Ted is just the type of person that we're looking for. And we're actually rolling out a self-directed retirement initiative at Spartan where we can actually stand up accounts for investors. And we haven't really broadcasted this or advertised it too far and wide yet, mostly because we've been working on the infrastructure first, but eventually, we're going to be offering self-directed retirement accounts, and Ted is the main the main point of contact for that. So Ted's a Seattleite, third generation, married his high school sweetheart, and lives in Beaux Arts, right? Beaux Arts, Washington. Perfect. So I think I hit all the high points. So Ted, go ahead and take it over.
Thank you. So guys, if you have questions, enter something in the chat this is to learn. And I'm not the smartest guy in the world by any stretch of the imagination. I've got some scar tissue. Ryan covered my background. When I was at Merrill, I was responsible for, well, one of my clients was $260 million. It was a family, it was a foundation, it was European callers, it was exchange funds. So I've seen enough, and I know enough to be a little bit dangerous. Anyway, enough about me. Let's talk about something that's interesting, that being self-directed IRAs.
Hey, Ted, real quick. It's a little bit difficult to hear you. Can you move closer to the microphone on your computer? Sorry about that.
Yeah, that's okay. Does this sound any better, Ryan?
Oh, that's 100% better. Yes.
Okay, fantastic. Okay.
Yeah, no problem. Yeah, thanks, guys.
So, okay, so self-directed IRAs are oftentimes referred to as SDIRA. Before we dive in, let's hit just a couple of bullet points that that I learned over some years. And you likely have some bullet points that you've learned, probably smarter than my bullet points. Here's my 2 cents worth. Number one, I should have added, the reward you seek is totally related to the risk you're willing to take. Risk and reward. To reduce your risk, you diversify. You know, basic. Another golden rule, take your age, put a percent sign behind it. That's the percentage of your portfolio that should be in bonds.
Sorry, Ted, can you get a little bit closer still? We had you good, and then it kind of went back to a little bit muffled.
Okay, I'm gonna lean in here to the computer. Does this sound any better?
Talk again.
Does this sound any better?
No, not really.
Okay. We're continuing to play with the laptop here. How does this sound?
Not really. Try opening a window.
Try to open a window. Let's just see here. This is a bummer.
Yeah, it's just a little bit.
We'll try to
take your time too. We've got what?
Headphones,
now.
good idea.
Do what now?
Headphones seems like he's putting on. That's a good idea.
Yeah, that might do it. Sorry, guys. I just want to be able to hear you. So good stuff coming out.
Does that's how you got me now, Ryan?
That's really good. I think if you guys can, yeah, there you go, perfect.
To reduce our risk, we diversify. Another golden rule: take your age, put a percent sign behind it. That's a percentage of your portfolio. Oftentimes, people think they should have in bonds. It's hard to do when the stock market is going good, as it is currently. We've all seen bear markets. They come surprisingly fast. And the reason I wanted to touch on that is right now interest rates are low and you can't get anything from a bond. So in my opinion, a Spartan private investment is a bond surrogate. Something to keep in mind. Looking forward a little bit, in retirement, investors generally don't want to take more than 4% out of their investment portfolio to support their maintenance and lifestyle in retirement. You can't manufacture that at the snap of a finger or the drop of a hat. So the point is, the Fed has been lighting the market on fire. Harvesting some gains occasionally is a good idea. You can't get anything from the bond market, and you can't find automatically $1.5 million in private investments that you're comfortable with, or whatever, if that's 60% of your portfolio or 70%. You can't just go out and find that automatically. So don't wait too long to start sprinkling into your portfolio investments that on the aggregate, if you're looking at a $3 million portfolio or whatever the value is, you've got to architect, you've got to manufacture that stream of income. So if you're 60 and you want to have about 60% of your portfolio paying income, There is nothing wrong with a 2% or a 5% position in a private placement of an exempt security, such as what Spartan does. And there's lots of other really smart people out there packaging these investments. And the retirement account is a likely candidate to be the holder of that investment. Now, let me touch on, I'll slide to the next page here, but I want to touch on something before we get too far. The custodians aren't great at this, and you don't want to use a custodian like Schwab, Vanguard, Fidelity. And the reason you don't want to do it is they're particularly bad at it. If you're shopping for a custodian to work with on private investments, you're going to be looking for custodians where you just don't recognize their name. I think the last slide that I'll get to here in about 5 minutes lists a couple, but Entrust Group, Millennium Trust Company, Forge Trust, to just name a couple. Saturday morning, go to their website, look at what they're doing. You'll recognize that, yes, without a question, the whole world either already knows or should know that they can use their retirement account for this kind of investment. However, most of the custodians that deal with alternatives, they are not part of the Depository Trust Corporation, which is a division of the Federal Reserve. They're not part of the ACAT system, ACAT, Automatic Customer Account Transfer. So they're not dialed into the ACAT system. There's 32 or 33 banks that are part of the Fed's Depository Trust Corporation that are a part of that. That's why you can, from Fidelity to Schwab, from Vanguard to Merrill Lynch, you can, with those firms, do an ACAT, move money in 2 or 3 days. These custodians that work in alternatives, they're not. And so it's going to take 2 weeks to a month to get something done. So don't try and do it in a hurry. Okay, now on this screen, I've got 2 different images. On the left, I've got a file folder. On the right, I've got a clipboard. If an investor just goes to, for example, Forge Trust, which Spartan is working on a relationship with Forge Trust as we speak. If you go direct to Forge Trust, you can do that. Totally okay. You will open an IRA account. You will transfer some funds into the IRA account. Generally, it's done by wire. So there's, to get paperwork to the losing and the gaining firms, it's going to take 3 or 4 days for that piece to happen. It takes a few days for an account to open. It's very conceivable you could get something done in 2 weeks. You would have done a transfer, not a distribution, moved funds from, let's just say, Fidelity to your new Forge Trust IRA. Now, one of the page forward here, so let's talk about costs. I want to drip back to the previous page, but with cost in mind, if you have 4 investments in your IRA account at Forge Trust or one of the other custodians, your average expense on a yearly basis is going to be about $1,500. And the reason I say that is as follows. The custodians, they don't have an assets under management fee. So they're not like, your Vanguard index mutual fund that's going to ping you at 11 basis points or 14 basis points. Because they don't have assets under management fee, they nickel and dime. So if you buy a condominium, and Ryan, let's just say you buy a condominium in Seattle and your tenant is paying your IRA monthly rent payments into your IRA. Well, each time that payment hits, you're going to get hit for $25 or $35, depending on the custodian, for that deposit. You've also got to marry a deposit slip with the funds and have it sent into the custodian. And that's how they make their money. So if you have a hedge fund, if you have that condo in Seattle, if you have a Spartan investment in your portfolio, every time income is paid, every time you make a transfer, every time you make a contribution, there's a $20 to $35 fee. If you have an investment, it's about $100. You can start to see where accounts that are active they start to ring up the cash register for the custodian. And that's not necessarily wrong. It's just from my perspective, knowing how hard money deals, you gotta jump on that right away. Time is for the essence in a lot of transactions, and the custodians clog that system up just by the nature of the industry. Okay, so let's look at the right side, a file folder that's halfway open. What is that? What am I trying to get at there? Here's the approach that we are taking at Spartan. The investment in your IRA account, it's not on the right side where there's multiple entries. There's not going to be multiple entries in your IRA account if Spartan is involved. We're going to assist our investors by creating a trust. We will collect an SS4 form from the investor, get their signature. That allows us to create a tax ID number for a disregarded entity. On the SS4 form, we're telling the government the owner of this account is the retirement account. The tax ID number is assigned to a disregarded entity. We're going to open a bank account for this disregarded entity. That means that the 1099 that comes to the account owner or the trustee of the IRA account, they don't have to pay, if you've got interest income or capital gains, it's not a taxable event because that tax ID number that owns that trust is owned by the IRA. So in my mind, as I was trying to portray this or put an image on the screen of what this looks like, on the one side of the screen, we've got a clipboard with a number of entries. And that's how it looks if you work with a custodian and you have several different investments in the account. The other side of the screen, we've got one folder. It's intended to say, you've got one investment. That's a trust. Now, you have to be detail-oriented. It's up to you, the trustee and the account owner, to keep track of when income gets paid to that trust account, which investment did it come from? Is it interest income from this investment? Was it a return of principal from that investment? Suffice it to say, all of us that have a couple of bucks, we're mindful of what's happening with our investments. To me, $1,500 is a lot of money. The point is, there's a way to deal with self-directed IRA account. Have a trust owned by your retirement account. You're the trustee of the trust. You have signature powers for the investment in the trust. So if you've got a hard money opportunity that you find out about on a Monday morning at 9 o'clock, by noon, you're at the bank sending a wire because you've completed the PPM and subscription agreement and the investment's done and away you go. I glossed over that pretty quick. There's a lot of nuances to this. And I don't want to, I want to leave time for questions. So let's finish up and then we'll open it up for questions. Let's see, just a couple of cleanup items here. Every retirement account needs a custodian. Some custodians are good at publicly traded securities. Some are better at private securities. So the custodians you're going to be looking for, they're not the Schwabs and the Fidelities. They're just not in this business. Okay, the custodians charge based on activity. Covered some of those points. Investors who use the trust approach only have one investment's lower period of control. I think we've covered that. Let's just keep moving here. Oh, guys, get a load of this. Minimize me in this presentation and bring up your Google browser and Google DOL approves private equity for defined contribution plans. And here's what that means. Pretty soon you're going to be able, by the way, that came out in June of this year. Pretty soon in your employer's 401k plans, in the life cycle funds, which are the funds that have, a target retirement date of 2040 or 2035 or 2030, they're going to start sprinkling in private investments as a sleeve or a part of that allocation. 2 weeks ago, Spartan decided to pass on and Ryan, you might need to help me here, it was a $25 or $28 million opportunity that we were bidding on. And there was meat on the bone. There just wasn't quite enough meat on the bone for us to bite off on it. The point is this. while cap rates are lower than they were in the 90s, 5.25, 5.5, that's the sandbox that we're in currently. If there is real meaningful 401k allocations coming into the Black Diamond property that we were looking at earlier, or some of the other storage opportunities that Spartan is involved with, 4 or 5 or 6% of all of the 401k dollars in the United States of America, that's a big chunk of dough. So while the stock market currently with a PE of 23 or 24 times, that seems a little rich to me, bearing in mind that in 1982, after that 14-year sideways market, the PE ratio of the Dow Jones was 7. So the stock market seemingly has some ground it could give, but if 401k plans are now opening up to private investments, real estate being one of those, I would say that's an asset class that, worst case scenario, probably isn't going to tank. It's a hard asset, it's collateral, it cash flows. There should be some support over the next 10 and 20 years to real estate, commercial real estate, and from my perspective, storage specifically. Yeah, I don't want to dwell on this. Let's keep moving. The next item on the slide are custodians that, if you're scratching your head and want to learn more, go to each one of these guys' websites. Look at their forums. Just get accustomed to looking at what they're doing. Let's just keep going to keep it relevant. Okay, so
Ted,
yes, sir.
when you open up for questions here, I just wanted to give one example of a real deal that I'm doing with my IRA that you just described. So I was at an airline called Air Wisconsin, and when I quit my airline and I moved over to Alaska Airlines, I was able to roll my 401k into a self-directed IRA. I called Ted's company and said, I want to take my IRA and I don't want it with T. Rowe Price anymore. I want it with a company that would allow me to do a self-directed IRA. Ted said, or Joe at the time, no problem. They set up my account, and I actually used my retirement account to invest in a 300-unit apartment building in Tampa, Florida. And every month that asset sends me about $300 direct deposit ACH to a checking account that is my retirement account. That is a real live example. So I've been earning 8% distributions on that investment for about a year and a half. And I am a partial owner in that business. So I just wanted to give kind of a brass tacks example of like everything that Ted talked about. I had those options, right? I could have gone to a custodian and then they would charge me for every deal that I did. They'd have to review every deal that I do, whatever. I could set it up in an LLC with checkbook control, and then I'd have to do the corporate formalities of my LLC every year and all that work, right? What we're rolling out at Spartan, which is, I think, unique, and what made WealthFlex unique, in my opinion, was the fact that instead of going to a custodian, we create a trust agreement that then gives you control over what you invest in, and you don't have to go to a custodian every time. You don't have to set up an LLC. You don't have to do any of that. You create this go-between trust document, and then it's still your retirement account, and you don't pay tax penalties or whatever, and then you can go put it in whatever you want. Now, like Ted was talking about in the beginning, I thought was really interesting, the asset allocation. If you're 40 years old, 40% in bonds, right? But you want to have some asset allocation in your big picture to be, private placements, real estate, stocks, bonds, mutual funds, traditional investing, but then also a mix of some other stuff like non-traditional stuff. And, you know, if you don't necessarily have the cash and you're trying to asset allocate with your retirement account, or you have both and you're just asset allocating the whole pie, you know, a self-directed IRA would enable you to invest in a syndication, which is what we're talking about here. So anyway, I just wanted to show a real example because I've invested in 2 apartment buildings, a neighborhood development. So here's a good example. So I've done 2 apartment buildings, one in Phoenix, Arizona, one in Tampa with my IRA, with my self-directed IRA. I invested in a self-storage development in Michigan and a neighborhood development in Michigan. And then I've invested in a hard money loan with a guy who wanted to buy a storage on bridge lending terms. And my fees per year for that account are about $200. So I don't pay, you know, some custodians, if you go to a custodian, every single time I do a transaction, they're going to charge me $300 a year for every transaction that I do, just as an example, right? So I just want to make you guys aware of that. You know, if you go to a trust company, you know, for example, like New Direction Trust or New View Trust, you know, just be aware that there will be fees that they charge you per deal that you do. There could be, right? So, and those add up. I mean, I'm in 7 deals with my IRA. So $300 a year, you know, could be $2,100 a year in fees. So just be aware that, you know, of the different fee structures and how it works. Personally, I don't think registering with the custodian every time I do a deal is a big deal. It's some paperwork and yeah, there's some back and forth, but at the end of the day, you know, those fees do add up. So just be mindful of that. So I just wanted to add that because I always like throwing like a real deal on the table, like how I personally use my self-directed IRA and how I've benefited from it. So thanks, Ted.
Pleasure. Who's
Yeah.
got a question?
Hey guys, I thought I'd pop in. Can you hear me?
Hey, Tyler, how you doing?
Good to see you.
Yeah.
Yeah, I was personally curious. I know there's a lot to touch on. That's the hard part.
Yeah.
I was personally curious, and I know you alluded to it in the talk, but kind of like how, I'm just not very familiar myself. So how are taxes treated, and just some of the elements on that side of things. That's a very big curiosity that I have.
Can I just chime in real quick and just give, if there's one thing you take away from all of this when in regards to taxes, you will get a K-1 if you invest in a syndication. And yes, it does apply to your taxes. So don't disregard the fact that when you do a syndication that you shouldn't hand that K-1 to your CPA still. Too many times I hear investors say, it's in my IRA, it doesn't matter, I don't have to worry about taxes, and that is dead wrong. So anyway, go ahead, Ted. I know you've got more.
Yeah, so great question. If there is no leverage used, you more than likely don't have any action to take. Going back to the one of the earlier topics, to get a tax ID number for an entity, that being a trust account, you have to complete the SS4 form. We bring the trust document to the table for our investors. I help the investor with the SS4 form. I'll get the EIN number and I'll customize the trust document so the investor's name, the investor's account number at Forge Trust is input into the trust document. So as long as there's no leverage or unrelated business taxable income, UBTI, as long as there's neither of those, and once in a blue moon you get an investor that's subject to backup withholding, that can mess with things a little bit as well. But if you don't have that stuff going on, and you're just an equity or a debt investor in whatever, if you own a condo, you paid cash for it, you don't have anything to do. Now, run that past your CPA, but I'm here to tell you that's what the CPA is going to say. If you're a cash buyer, no leverage, you're not a funky origin. I should not say funky origin. You don't have a complex tax situation. You're probably not subject to backup withholding. So taxes shouldn't be an issue. And even if there's leverage, and let me touch on that for a moment. Spartan might leverage a property by 30% or 40%. What that really means is that the income that's paid to you, your retirement account, not you personally, but your retirement account, is responsible to pay tax on 30% or 40% of the income that's earned in a given year. That's done on a 990T form. So if you're taking notes, 990-T. It's a one-page tax form. It's not totally complex. And for what you get from the diversity of whatever the asset class that you're investing in, oh, by the way, I want to take a moment on that. When we're done, tonight or this weekend, look at the Yale Endowment Annual Report. It's fascinating. That's the marquee portfolio for institutional asset managers. You can see their asset allocation. They've got maybe 15% in publicly traded securities, stocks and bonds. The difference is in alternatives. Okay, now that says something. I mean, that really says something. These are the best money managers in the world, arguably, and they've got a 15% allocation to the stock and the bond market. And I'm going on memory there. That might be 18%, it might be 13%. It was a couple months ago that I looked at that. But the point is, the closer we move to needing to pull on our investment portfolio to support our lifestyle and our maintenance, we just want to be that much more sure what the asset is that we're invested in. It's hard to sell into a bull market and harvest your gains, but the wisdom of the ages is your age with a percent in the line. Anyway, back to taxes. Tyler, great question. If you've got leverage, you've got a tax return to fill out. That's no big shakes. If your CPA does it for you, you might pay $400 to have that done. That is no big deal when you look at the diversity that you have and the durability of the asset in the teeth of the bear market. I mean, Ryan, you tell me, did your apartment go down in value by 30% earlier this spring in March and April? No. And did it keep cash flowing?
You'll find that I definitely take a lot of risk in what I do, but I'm a very risk adverse investor. I like B plus properties. Some of the things that we do at Spartan are pretty, we take risks, but like Black Diamond, I love that because it's going to be an A class property. I like, or at least, we're buying a C, but we know that it's eventually going to be a B or a B plus. And, that apartment building is in my mind, a very low risk endeavor. It's great school districts, light renovation to the building, very, very high occupancy. It's stable. I take my risks in other places, so I like to invest passively in a little bit more stable assets. Couple questions here. So Ryan, who do you use for your SDIRA? Well, I use Spartan. Probably effective in a week or two. My SDIRA is $600 a year. Ted said it'd be closer to $1,500 a year. So I think the $1,500 a year number. Where did you come up with that, Ted? Was that kind of an example of a custodian transaction by transaction? That's what I thought. Okay.
Yeah.
Go ahead, Ted.
So I'm going that I saw an investor about 2 years ago. He had 6 or 7 rental properties, and his bill was between $3,500 and $4,000, and it's just the monthly activity. I've seen a lot of investors that are active that have a $1,500 bill. So depending on the custodian and depending on how hard you lean on them for a concession, this is all a little bit squishy, but $1,500, I've seen it a lot.
Yeah, and that's kind of again, it's kind of one of those things where it just depends on how the fees are structured. It could cost that much. I've seen, I've actually looked into another custodian, and with all my assets and how I've invested, it could be closer to like $4,000 a year. So just be aware. One question I'd ask a custodian is, do you charge per deal that I invest in? And then is that fee annual? Because you could make a small $10,000 investment. Now you're paying $300 a year on that investment. That's not a good situation. But if you're like, if you're doing one deal, maybe not as big of a deal. But so another question we had is, what will the Spartan annual fees be? I don't know yet. That's what we're still kind of sorting through. I know this is a small group. We're not really advertising it all that much. But I will say this. With our setup, it's unique because we take the custodian out of the transaction as far as what you're deciding to invest in. So you're not paying a per deal annual fee. You're paying one fee that covers your entire account, and it's going to be hopefully going to be pretty low. I don't want to put a number out there and anchor everybody to that number, but it's not going to be in the thousands. Definitely going to be probably closer to the hundreds, low 100s. And we'll let you guys know as soon as it comes out. Maybe this group can be our test case if you guys want to. Not that we don't know what we're doing, but just the first people that kind of come into the program. One question: most of my clients invest IRAs into residential real estate, single-family residence primarily. Are you a resource for clients' interest in this investment? Oh, go ahead. Sorry.
Yeah, let me just interject there. So Kevin, on that one, we're happy to share the trust document with you so that your clients can go to custodian, whatever. As you know, the billing on that and calculating the NAV on that investment monthly or quarterly, contingent on how you do your billing, that's a nightmare. But then that's on your CCO, and we want to see people be successful. So we're in the early part of talking to institutions, family offices and institutions, and in the formulation of those relationships, so that when we have a deal of 30 or 40 million and an RIA, has an appetite for 5 or 7 million, we can hold that aside. So to the end that we're supporting each other in our regardless of whether or not you do any business with Spartan or your investors, we want to see you be successful. So we'd be happy to talk offline, share our information and documentation with you, and hopefully, you light it on fire. So we're happy to connect.
For our deals, what dollar amount are you looking for investors to invest, and what is a typical return over what time period? Depends on risk. I think 50,000 is our minimum. I would like to share a screen here, share a slide. I think this is important to talk about what typical returns are. Let's see here. I'm going to open this up. Just give me just 1 second here. All right. So this is a live deal. It's already funded, but I wanted to give you an idea of what you should be looking for on risk return. So let's see. But I always like talking about this graph here when we talk about risk return. So core plus, value add, and opportunistic is kind of the buckets that investments can fall into. And as you get more risky, you should expect to see the curve go up, right? You should expect your return to be greater the more risk you take. So opportunistic up here, I'll give you a good example of that. That is building a self-storage from the ground up. You have a lot of risk. You are buying raw land. You are risking increasing construction costs. As anybody that is building anything right now knows, that lumber just doubled in value. You have no way to control that. You have jurisdictions, bureaucrats, permitting, timelines can get delayed, pushed out. We call it dead body risk. When you start moving dirt, you just never know what you're going to run into. And then once you build the project, you have to either sell it or you have to lease it up. And that introduces an entirely different and a new risk, because you have all this debt or all this money spent building the property, and now you have to transact in order to create value. And if you can't transact, you have a lot of debt or a lot of money spent on something that you can't produce value from. So I like to start with opportunistic. That is the most extreme risk you can take. That should be in the low 20% range annually, in my opinion. That's where it should start. So when you ask typical, I like to just give you the perspective. Now let's talk about core down here. Okay, this is a low risk. This is investing in a triple net lease, CVS anchor tenant, 40 years. They're not going anywhere, right? You're investing in the building that has an anchor tenant like that who's got a 40-year lease or a 20-year lease. This is the lowest return. The building's already built. The tenant's already placed. They're on a main street in a good town. There's a very low likelihood that anything's going to happen to that business. And I don't want to get into a debate about retail, but the idea is that the tenant's going to be there for a long time. Or this is your A-class downtown, apartment building that's fully leased and stabilized and already built. The value add, this is the project that we just funded. Oh, I'm sorry. Core is somewhere between, and correct me if I'm wrong here, Ted, probably 5 to 7% annually. This is kind of where Spartan's sweet spot is. We do a lot of value add. This is an existing self-storage business. It's got tenants, it's leased up, and the operator is just not running things that well. They're not marketing. There's units offline. There's rehab to be done. There's improvements to be made to the property, but it's not. But there's some risk in it, right? There's some risk in raising the rents 25%, or turning over all the managers, or having to dump $1 million into operational improvements. That's where you sort of, or maybe the market. It has something to do with the market. The market's a tertiary market. You're not in a primary metro market. You're in the outskirts, right? So it's kind of a combination of those. That should target between 15, probably 16, 16% to 19% annually, depending on, again, the risk factors. And
that should be cash flowing from day one, correct?
Not necessarily, but ideally, yeah. Ideally, it would be cash flowing from day one. Yeah.
And Ryan, to the person who asked the question, you can go back to our YouTube channel, and we did the second meetup was on metrics. So we kind of discussed numbers in a little bit greater detail. So go back to YouTube channel, and it's there.
Yeah, and Core Plus is kind of like, it's kind of like a single-family rental property in a secondary market or a tertiary market. It's kind of like, you got a tenant, there's no repairs to be made to the property. It's just kind of like you're buying it. There's a little bit of risk of tenant turnover, but you're really not, you're really not taking on a huge amount of risk. But there might be something wrong with the market, or maybe you just have some tenant placement risk, and those returns are 8 to 14% per year. So when you say typical, I never like to give a too straight of an answer there, because it depends. As a sophisticated investor, you should be saying, where am I on this scale? If you're building something from the ground up, you're taking on a lot of risk. That's why your return is high. If you're buying that stable asset, well, Ryan, why isn't my return typical here? Well, it's because you're buying something that doesn't have a perceived amount, a heavy amount of risk. So our typical return is either value add or opportunistic. That's the assets that we focus on. Every once in a while, we might put something on the table that's between Core Plus and value add. But for us, it's usually value add and opportunistic for our group. So did that answer the question? Hopefully that. out. Cool. Oh, time period, 5 years. So, and that depends too. So I'd love to go on a little bit of a tangent about this. If you're building from the ground up or investing in something that's opportunistic, the shorter the timeline that's projected to you, the less likely it's going to happen. So let me say that again. I'm in a 9-month, 36% return deal right now that's been going on for 3.5 years. So if you're building from the ground up, you know, with some exceptions, I like to see a minimum of 3 years, a minimum of 3 years. I don't care what it is, from the time that my money goes into the time that money goes out, and knowing that I'm and that's probably going to be a 20% per year return. So I want to see 3 years and 60% total return for ground up construction. Otherwise, there's just too many things that can happen. If it's residential, you might say, well, it only takes a year to build a house, Ryan. Why do you need 3 years? Well, what if you get delayed in permitting? What if, and if you have permits, well, okay, that's a consideration. What if you get to the point of selling the property and the market changes, and now you've got to convert them into rentals for a little while, right? So whenever I see ground up construction, I like to see the timeline go longer. So if you're thinking, well, I like to get in and get out, stay away from the opportunistic, stay away from the ground up construction, right? If you want short-term timelines, stay away from that stuff. Where if you're okay with for storage, we like to see 5 to 10 year timelines for ground up. The Black Diamond project, that's a 10-year timeline. So can you stretch the timeline 10 years and hit 20% per year for a total return of 200% or more over 10 years? Yes. Okay. Then I can see that the deal is strong enough to do. Otherwise, it's just not enough timeline to fall into to actually perform. So sorry to go on a tangent about that, but I know people want to see those fast deals, or money goes in, money goes out sometimes, and they don't want the long-term holds. And don't confuse a short timeline with it meeting the realism of actually performing within that timeline. Because a 36% return that takes 3 years is now not making anywhere near 20% annualized. Now it's making 8%, 9% annualized. For the risk, I could have done 100 different things and made that kind of money without the stress of wondering what's going on with my new construction project. So our typical turns for value add are 5 years. So that Tyler Longview deal is a 5-year hold. And I'm very comfortable with that timeline because, money goes in, properties are cash flowing day one. And by 5 years, that'll give me enough, probably in a year, I think we're going to have our value add completed. So we'll have all the roofs done, drive aisles, paint, trim, marketing package, expansion of the one property. Everything will be done within a year or a year and a half. And then it gives us another 3.5 year cushion to sell the property and hit our bookends. So that's a very comfortable timeline in my opinion. So I always match because like I said, whenever you do ground up, you've got we didn't catch that in the survey. There's another permit that we have to get that's going to take another, and it doesn't matter how experienced you are, you can't predict what's going to happen in ground up construction. So anyway, I know that's just me and 5 years of pain and being in some passive ground up construction deals that have gone way longer than projected, and hearing oh no, we got all this stuff and it's going to be quick and we're going to get out there right away, and doesn't always happen that way. So anyway, I'm in one of those right now. Short-term deals was supposed to be 3 months. I don't like short-term deals. Short-term deals scare me. High return short-term deals it just doesn't make me, it makes me question the aggressiveness of a timeline. So, check the Q&A. Where's the Q&A? Oh, oops, I forgot about the Q&A. Do you have to be a accredited investor to have a self-directed retirement account? No, you do not. You do not have to be accredited. You could be anybody to be a to set up a self-directed retirement account. Good. That's a really good question. I actually haven't had that question, I don't think, in a while. Yeah, but anybody can do it. Anybody with an IRA, you could be. I could set one up. What's the legal age to set one up?
You've got to have earned income, and you can't defer more than you earn in a year. And in the state of Washington, you've got to be 13 to have earned income.
Okay, so I could set one up. In other words, can these type of retirement accounts be converted into a self-directed account, SEP, traditional IRA? Yes. Yes, they can. We do not require all investors at Spartan to be accredited, no. Some offerings, so you've got, I think we talked about this in an earlier one, but some offerings are 506C and some offerings are 506B. The difference is 506C, everybody's got to be accredited, but then we can advertise. 506B, we have to have an established relationship. So we have to know you, talk to you, have met you, not in person necessarily, for about 30 days typically. And then you don't have to be accredited if we do it under 506B. All of our offerings, with the exception of the last offering that we did, have allowed non-accredited, investors. And the proper terminology there is sophisticated. If you're a sophisticated investor, you can invest in a 506B offering, which means that you can reasonably assess the offering and kind of, have some level of sophistication to understand what you're investing in. So,
and Ryan, if I could just interject on that.
Yep.
Oftentimes, well, I'll say it this way. My experience at Yield Street, we dealt with thousands and thousands of investors on, any given open offering. And frankly, most people put 25 or 50,000 bucks to work in a deal. That's just how it is. And all of those investors were accredited. $7, $8, $10 million accounts. People are still plugging away just because our system was automated. So, they just take 25 or 50 in every deal. Now, not every deal size was that small, but it is not uncommon for an investor to put 50,000 bucks to work and they're worth $5 million. It's, it's 1% of their net worth. All right, suit yourself.
Very good. Any other questions? Got a couple more minutes and then we'll wrap up for tonight. And the next one will be on the 24th of September, 4:30. Any suggestions for topic? Does anybody have any? Otherwise, we just pick them, but based on the first meeting.
Well, I'll just jump in and say a quick thing. Something to my surprise that I learned yesterday. I had this a little bet with my loan officer. We were going to do a class, how to purchase real estate. And I'm like, let's do an online class. And he's like, no, let's do an in-person class. And I'm like, well, no one will show up to an in-person event. And we decided to bet, and we sent a poll on Instagram and Facebook and just asked people. And to my surprise, 70% said that if that would be an interesting class or event, they would go in person today, assuming that all of the guidelines are followed on both Instagram and Facebook. And it blew my mind. So to your, Ryan's topic, in the beginning of the video, maybe we could enroll those in-person events sometime sooner than one day in the future.
I'm okay. And, I'm okay with being respectful of still having the event and still having it on Zoom. So I don't know what people's opinions are, but, I have no problem social distancing, masking up, and doing a live event. I know that some events are starting to come back, but we could host at our office probably. Work out those details, Ted. We'll have to work those details out. But yeah, we're over in Bellevue, right by T-Mobile. So, it's kind of a nice, if you're in the city, you can kind of buzz out real quick, and if you're on the east side, even better. So yeah,
just an idea.
I'm all about it. So if you guys want to do a live one, let me just make sure we got the logistics covered, and then we'll put that in the email. But for now, September 24th will be our next one, and we'll try to do it live. So perfect.
And Ryan, one more thing. If we have any other questions about self-directed IRAs, because there's a lot of detail behind it, would you still be a resource to answer those questions after this call? Maybe
Yeah.
like email, or what's the best route?
Email's great. And,
Okay.
and Ted.
Yeah. Ted.
Yeah, I'll put Ted's email in the.
So Tyler, I learned decades ago, be a good community member. It always comes back to you. So to the degree that we are available, I'm eager and happy to have a conversation with you, your investors, where we can share our resources. I'm going to put the work on the investor to either approach the custodian directly or to have them create the trust and things of that nature. But if you need 15 minutes of, hey, what about this? Can you, absolutely happy to help.
Sounds good. And that's the whole point of this group. Again, sophistication level going up, networking going up, better resources. As they say, your network is your net worth. So, let's try to expand the tribal knowledge and work together to be better passive and sophisticated investors. So with that, we'll go ahead and end for tonight. Thanks, everybody. We'll see you back on the 24th, and maybe we'll see each other live. So.
Bye, everybody.
All right. Take care.